Oh, hey there! We've got a video here for you that runs through how to build a sigmoid fade curve. This is super useful stuff when dealing with private or disruptive company valuations, as well as when executing what's priced in analysis. Jeff is going to run through this one with you. I hope you find it useful. I'm Rima, and I'm part of the team here at theinvestmentanalyst.com.
Thanks, Rima, for the introduction. Hi, I'm Jeff, and I'm the founder of theinvestmentanalyst.com. For a number of places on the platform, we've talked about the sigmoid curve and how we can use this as an effective way to fade the evolution of cash flow from the end of a visible period to a longer-term terminal value state. The nice thing about a sigmoid curve is that it gives us controllability that we can relate back to a company's business model in terms of sustainability of competitive advantage and the speed or the loss of erosion of that competitive advantage over time. Now on screen, what you can see is a graphical representation of the sigmoid curve, just a simple S-shaped curve together with that equation. When it's up there on screen, it does look nastier than it really is in practice. And I think when we go through the model build here, we can break down those elements into smaller, more digestible chunks of knowledge. If I just scroll up the page, we are going to go through and we're going to build a fade curve that we will apply to a return on invested capital profile. At the start of the fade period, the return on invested capital is 15%. At the end of the fade period, we want to fade the return on invested capital down to 7%. That essentially identifies a simple drop of 8% over the course of that fade period. We have identified a steepness coefficient at 0.6. We will talk about what that means and the impact of that on the sigmoid curve and the 15-year half-life. So the 15-year half-life is representing the length of time it takes to erode 50% of that drop of 8%. The steepness coefficient provides us with an indication of the velocity of the drop through the midpoint. So I'm going to break this modeling up into a few little sections here. We're going to have what I would call a sigmoid factor. I'm leaving this space here because I want to put a little bit of data visualization there at a later stage so I can illustrate the impact of changes in the half-life and the steepness coefficient on the shape of the fade curve. And I'm just going to replicate the equation. So it is 1 minus open up a bracket, 1 minus open a bracket, 1 over, and then I have an open bracket, 1 plus the exponential, and it's the exponential of the steepness coefficient applied to the period between the current year and the half-life. Now, the steepness coefficient, we actually did name this as a variable in our spreadsheet. We've named it E, so if I just type in E, and I put that into my equation there, open brackets E, put that into the equation, multiply it by the year that we're in, and I'm slightly obscuring the timeline that we have there, but we've got a yearly timeline index. The half-life, again, I made that as a variable, and I'm going to close off the brackets there for the exponential, and then close off the rest of the brackets to enclose that equation. I'm going to press enter and I get 100%. Now, as I copy this across the page, just doing Control R there, what we see is we start to see the fades start to come in and we've got a little bit of erosion there. Now, by the time I get to year 15, what we should see is that we're hitting 50% because 15 years is the half-life. So we're halfway through the drop. If I keep copying this across, we've gone out there for a good number of years. So it just gives us a lot of flexibility, especially if we get really long-term fades. And what we can see is we've got the drop, and then essentially by the time we get to around about year 27, 28, 30, we have fully faded the drop on that curve now. On a visualized basis, using the sparkline I've built into this spreadsheet, you can see is the impact of that sigmoid fade factor. I will apply the fade factor to the 8% drop in return on invested capital. Just breaking this up into as many digestible chunks as I can. So I'm going to take that, copy that across our page. So there's our drop, and we will apply drop with the fade factors. So we're going to have 8% multiplied by 100%. Therefore, the rate will remain at 8%. But as the fade begins, we will see a decrease in that percentage. By the time we get to year 15, we are halfway through the fade. By the time we get to year 15, we've faded through half of the 8% drop. And if I copy that through straight to the end, we get the entire fade nicely coded in there. So really, we're just working at the fade factor using the sigmoid curve, looking at the drop, applying that fade factor to the drop. And then that gives us kind of the evolution of fade in relation to the return on invested capital. Now, that's just the fade drop that we focused on there. What I will identify is the sustainable or terminal return invested capital, which is our target or baseline figure of 7%. So what we're going to be able to say is, okay, 7% is our baseline. We're going to add that 7% to how much we're dropping through the fade. And so what we can have here is the full evolution. This is actually the faded incremental return on invested capital. And what we'll see is we copy this across and we start getting towards maturity. By the time the fade is fully passed through the equation, what we should be getting to the baseline by the time we get to column AD in year 2024, we are fully fading that return on invested capital over the fade period. So most of this modeling actually is pretty straightforward. The one area where there's a little bit of thought required, and it's, to be honest, it's most of the time, it's trying to get these brackets in the right place and pulling that fade factor equation together. Now, if we were to make the half-life longer, so we've got a more sustainable competitive advantage, what you see is the curve, and you can see it shift there with that spark line. That curve is getting pushed further down the timeline. Now, if we were to make the steepness coefficient lower, so the velocity or erosion of the competitive advantage was less pronounced, what you'll see is we start to change the shape of that curve quite nicely and with some analytical control. So we've got a lot of control here over what happens with the shape of that fade. And that control really is through the two variables of the half-life and the steepness coefficient. I think this is actually a very good tool for analysts to have in their toolkit if they're having to deal with long-term forecasting and the associated issues with cash flow visibility, coupled with a long-term fade towards a sustainable position. Rather than trying to do fade subconsciously or consciously, whilst dealing with multiple interconnected factors during a visible period forecasting scenario, I think that becomes very difficult. I believe this Sigmoid fade tool allows us to simplify the operations while still maintaining some sort of control. I hope that was useful. Check out the other videos on private company valuations and what's priced in analysis, and you will see us making use of these fade curves. I think these tools really help us deal with some of the issues that arise when dealing with these valuation scenarios.